Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have our resident commodities guru, Rick Rule, former CEO of Sprott, founder of Rule Investment Media and the Rule Classroom, and co-founder of Battle Bank. Rick, thank you for coming back on the show.
Steve, always a pleasure. Thank you for inviting me back.
Yes, the pleasure's all on this side of the table, sir. I got to say, I'm really excited about the Rule Classroom. We have a new addition to the Rule Classroom. It's the Rule Classroom Plus for serious investors. Go ahead and give us a rundown of what someone can expect if they sign up for the Rule Classroom Plus.
Well, I think it's important to know about the Rule Classroom. First of all, there's a couple hundred hours of instructional programming. They're all free. That's meant to be used in conjunction with Rule Investment Media. The idea is that you come to Rule Investment Media, we review your portfolio for free. After you've done that, go to the Rule Classroom and begin to educate yourself on how to become a natural resource investor. The idea is that at the Rule Classroom, we give you paradigm and we give you technique for free. Rule Classroom Plus is meant to really introduce you to investments and introduce you to deep dives in investment themes. So you will get the ability to view archives, as an example, of our boot camps. You will have the ability to participate in proprietary one-on-one company meetings. You know, Steve, I've enjoyed for 45 years sitting in companies' boardrooms and having them try to convince me to buy stock, or sitting in companies' boardrooms and listening to them try to convince me to buy private placements and negotiating them. These are endlessly fascinating, and there's a drama to it. We'd like to recreate this. We'd like to bring issuers live into Rule Classroom Plus. Let them spend 15 or 20 minutes describing their wares, and then expose our audience to what real live due diligence looks like. After they've done their presentation, I and a panel of experts chosen by myself, all of whom are check writers in their own right, will conduct real-time live due diligence, not sponsored advertising. After that, our plan is to let those attendees who have participated in the educational lessons at the Rule Classroom conduct their own question and answer session for another hour after that. This is not for tourists. This is not an entertainment product. This is for semi-professional natural resource investors and speculators. There's a huge gap in the market, I think. There are financial public relations firms that work for the issuers. There are money managers who work for the investors. There are investment banks who get paid a lot of money for introducing the two without too much reflection on quality. This is meant to be a very different thing. This is meant to introduce a curated list of companies, not anybody who shows up with a check, but a curated list, very much like our conferences, to a very, very, very focused due diligence session, while simultaneously teaching the subscribers to the Rule Classroom Plus how to conduct their own due diligence.
Hey, you did the first one with Magnum Mining. That was a lot of fun, very educational. I've watched it several times. Adrian Day was on there yesterday, and he did a hour and a half deep dive. Any question you want to ask, you can, on Origin and Altius. Wow, he's really bullish on those. I'm loving the Rule Classroom. Honored to be a part of it. It's very exciting.
We're getting excited about it. I'm particularly excited about the feedback we're getting from the classroom members in the public discussion forums at the Rule Classroom. It's very obvious that for a small subsuit of investors, that this is a very useful product. What is amusing me is it's becoming a community. That there are members of the classroom who are forging their own private links with each other, introducing investment opportunities and conducting independent due diligence for the benefit of the entire community, which is at age 71, or pardon me, 71, my fondest dream.
Yes, I'm happy to be a part of it. Looking forward to it this afternoon. We're going to be you and I will be in a Q&A taking questions. So it's going to be a lot of fun. There'll be a link down in the pinned comment below. Join us over at the Rule Classroom. Okay, let's start out with some fundamentals. What are some basic things that you look at to kind of quickly eliminate, I'll call them red flags, quickly eliminate a company when, getting rid of the 90% so it doesn't waste your time?
Mercifully, at age 71, I have a very deep contacts list. In my youth, it would have been called a Rolodex. Now it's called something else. And so the first filter for me is, do I know the people? Or do I know people that know the people? Do they come recommended to me? It's very difficult to get my attention if you haven't been recommended to me by somebody whom I know and love and trust. So my first screen is a relevance screen, which is to say, are these people part of a reputable community that I have access to? And is someone who is reputable willing to risk their own reputation to introducing me to them? The
Okay.
second test is a different form of relevance. I'm not interested in exploring for a small deposit or buying a small deposit or building a small deposit. Everything, Steve, that can go wrong with a big mine can go wrong with a small mine. But a small mine can never make you big money. So why would I take big risk for small rewards? Specifically, if the in situ value of potentially recoverable reserves and resources don't exceed 2.5 billion US dollars, which is to say 1 million ounces of gold, recoverable over 10 years, with an indicated 25% return on capital employed, I'm not interested. If somebody talks to me about a 300,000 ounce gold deposit, which they can put into production cheaply, and then use that free cash flow to grow the company with little dilution, a bootstrapping approach, I don't want to know. If that's viable, it should be private. You shouldn't burden it with $2 million a year public company expense. So that's important to me. The third thing that's important to me is the offering terms. So often, Steve, somebody comes to me and says, we have a ground floor opportunity, an early stage opportunity. This is the first round of financing we're seeking, and it's only 25 cents. Only, that's the word. And then I look at the capitalization structure, and these guys gave them 5 million shares, themselves 5 million shares for a penny. So they just gave them a bunch of stock for a penny. And now a couple weeks later, not having done very much, they're trying to market some stock to me for 25 cents. They're going to use my 25 cents to create the opportunity that they paid a penny for. Wrong. Zero interest. You know, the fourth thing or fifth thing, depending on how you're counting, if I like the size of the prize and I like the people, what is their plan? And is their plan grounded in reality? You make money building companies by answering a series of unanswered questions so that the value proposition becomes more sure and more well known. So I always ask the people, with regards to the asset that you are advancing, what's the most important unanswered question? How do you propose to answer that question? Is the thesis and the proposal to test the thesis based on ground truths, or is it merely convenient for you? How much time will it take me to get a yes answer? How much money will it cost to get a yes answer? Do you have that money? And if not, where will you get it? About 80% of the time, Steve, when I ask that series of questions, the management team in question says, we've never thought of it that way, which is to suggest that they don't have a plan. It's very tough to get somewhere if you don't have a map. So about 80% of the time, that screens out people for me. It turns out that the unanswered question for them is, can I raise enough money to pay my salary for 18 months? I can understand why that question is of interest to them, but it's of no interest to me whatsoever. So I would suggest that at a very minimum, that's the starting point.
Okay.
And if you do that, if you look at 2,000, 3,000 public mining companies worldwide, just that simple test, what is it worth relative to what is it selling for? What is the unanswered question that will unlock value? What's the probability of a yes answer? What's a yes answer worth? What does it cost me to get there? Do you have the money? If not, where will you get the money? Who are you? Should I care about your plan? If you ask those questions, if you assume there's 3,000 public companies, I don't know if that's the right number or not in the mining space, you eliminate 85% of them. And eliminating 85% means that you don't have to waste any time and attention on them. You can focus your time and attention on the 400 or 450 remaining companies.
Yeah. Okay. Okay. So basically, so you're starting out with the people, just like Doug Casey.
Yep.
Do you know them? Do some of my contacts know them?
Yep.
If their name ends in Beatty, then you just move on
Yeah.
to the next step.
I mean, if Ross Beatty sends me an email and says, a young protege of mine who is backed by XYZ is doing something that I find important, I've written him a check, and I think that you could be useful to him, I'm on it like white on rice, right? But if I get an email from an intern investment banker at Schlepp, Schmuck, and Schmo Financial, in Toronto, saying we have a highly exciting opportunity, why would I care about something that excites an intern that I've never heard of from a firm I've never heard of that has no background in mining?
Yeah. Okay. Okay. And then the next quick elimination is how big is the deposit? You want at least 2.5 billion worth of recoverable assets. The offering terms, like you said, if they got in for super cheap and now they're offering it to you for 20 times the price, that doesn't
Yeah.
sound very enticing.
Money, Steve, is made on the delta between the price and the value. And if you assume that they're going to do 5 million shares in a quarter, okay, there's 1.25 million. If they've already issued 5 million shares at a penny, have a look at the blended price. You're paying 25 cents for something arithmetically that's worth 12.5 cents, except for the 1.25 million that you put up in the early stages probably is going to go 50% to G&A. So really you're paying 25 cents for something with a reasonably ascribed value of 6.5 cents. Not likely.
Yeah. Yeah. Not a very good deal. And then you go into your unanswered questions, and from there, 4 out of 5 times, they don't know the answer and have never thought of it, and you can move on
Right.
to the next company.
The idea really is to distill the universe of, say, 3,000 companies to 450. And out of that 450, in conjunction with people who I know and love and trust, develop a focus list of 50 to 75, which you
Okay.
follow and follow slavishly. You don't necessarily own them all, but you're trying to develop a target price. You're trying to develop an entry strategy. You're following their press releases. So when you see that they have less than a year's worth of working capital left and they're going to need to finance, you call them up and say, you have a problem and I have a solution. Can we get together? These are the price and terms that I would suggest would be appropriate. Most of the time they say no, but sometimes they say yes.
Okay. All right. So maybe we can expand on that a little bit, going from the 450 to the 50 to 70. Your process there for narrowing it down to like the fine tooth comb.
Discrepancy between price and value. Occasionally you find a company that you believe, like when I talked about Origin on your show a year and a half ago, it was very clear to me that that company was a 12-month double. And it seemed clear to me that the company was a 2 to 2.5 year 4-bagger. It had the potential to be a 5-year 10-bagger. You focus on something like that. Identifiable assets with a disciplined management team and a clear sense of where they were going. As Warren Buffett and my former partner, Eric Sprott, said, they both had the same quote: don't be afraid to be right. If the odds are stacked in your favor, don't just go big. Go till it hurts.
I like that. Don't be afraid to be right.
Yeah, don't be afraid to be right. They come along seldom, but when they come along, I remember, as an example, more than 10 years ago now, with Ivanhoe Mines, with Robert Friedland. I had the best mining financier of my generation, the single best, Robert Friedland. I had the best copper discovery in the world in at least 50, maybe 100 years in Kamoa-Kakula. I had a second deposit called the Platte Reef in South Africa that the government of Japan had paid $200 million to get a 10% interest in. That would assume that the other 90% interest was worth something. And I also had in the same corporate wrapper Kipushi, the highest grade zinc mine in the world, not producing in Katanga, but it was better than that. The share price was 63 cents. The government of China, through CITIC and a parastatal mining company called Zijin, had just paid $1.12 for their shares. They'd paid twice as much as the current market was. The company had 93 cents a share and it was selling for 63 cents. What was wrong with it? Well, copper was out of favor. Congo was way out of favor. So what? So what? When you're right, you have to have the courage to be right.
Okay. All righty. I like that a lot. It goes right into the contrarian narrative. All right. I want to play a quick game. You played this game with Lucian maybe 8 months or a year ago, and he called it bullish, bearish, or neutral.
Yeah.
And you remember that
I need
one?
to say it. I need to disclaim at the beginning of this. This is really good for audience engagement. And it's actually suboptimal content. Your audience needs to know that my opinion is an opinion of as of right now. And this opinion may be worth nothing in 6 or 7 days. So don't hang your hat on this for any period of time. And pay attention to what I have to say in terms of something that will cause you to study more, not buy stock.
Okay. All righty. We have the caveat out of the way. Let's put the time frame at your thoughts right now for the next 18 months.
Right.
Okay. Gold.
Bullish, sadly. Very bullish.
Silver.
18 months neutral to bullish. The market has to be led by gold before silver will follow.
Okay. Copper.
The same. Long-term bullish. I have near-term concerns about the economy.
Uranium.
Uranium as a commodity, neutral to a little bullish. The subset of uranium developer shares that will benefit from the changing structure of the uranium market, from a spot market to a term market, wildly bullish.
Okay. Oil.
Bullish.
Gas.
In the 18-month time frame, neutral. In the 5-year time frame, stupidly bullish. Confined to North American natural gas, not global natural gas. North American natural gas, 5 years, stupidly bullish.
Okay. Nickel.
18 months bearish.
Okay. And lithium.
18 months bearish.
Coal.
For both nickel and lithium, 5-year, very bullish. In 18 months, I think that you'll find nickel stocks and lithium stocks to enjoy the same favor that AIDS does. There is no hate as sincere as the hate of jilted lovers. And nickel, platinum, and palladium and lithium all have legions of jilted lovers. So these markets will be thoroughly hated when they bottom. And when they recover, they're going to recover with a vicious bounce. I suspect that occurs in 2026 or 2027. I'm studying those issuers frantically right now. I need to get in these things early. I need to anticipate hate. I need to separate the wheat from the chaff, the good, the bad from the ugly. But you gave me an 18-month time frame, and the 18-month time frame for all of those doesn't look so good.
Okay. Coal.
Bullish.
Okay. Interesting. Okay, now let's do a little more deep dive on each one. Let's start out with gold. We've hit some all-time highs here, And now caveat here, this is in the what do we call it? It's the short, or it's in the it's in the U.S. dollar. So you said sadly bullish on gold here. I wrote the yin yang for my weekend show here. We're sad because gold is at an all-time high because it's bad for the economy, but we're happy because it's
We own some. Yeah.
good for our bank accounts. Yeah.
Yep.
What are your thoughts on gold right now? Do you see
Well,
any?
I would point out to you that the narrative is at its all-time high, but that's the nominal high. If you take into account the deterioration of the purchasing power of the US dollar, I suspect that the all-time high would be 2,800 or 2,850. And I suspect that the delta between the nominal and the real all-time high is something that people need to pay attention to. Gold traditionally has done well when people are concerned about the maintenance of their purchasing power. In fiat currency denominated savings products, we have gone through the math on your show many times. But suffice it to say, I think that the deterioration of the US dollar purchasing power doesn't relate to the CPI at all. People can refer to our earlier interviews for that thesis in detail. But I suspect that the purchasing power of the US dollar is declining by 7 or 7.5% compounded in terms of the basket of goods and services that the average household consumes. If you believe that your savings are deteriorating at 7.5% compounded, the idea that you're getting paid 4.4 or 4.5% in a savings product means that you're losing 3% a year compounded. There is nothing that ought to make you more concerned about the maintenance of your purchasing power than the arithmetic guarantee that you're losing it. The consequence of that is that I expect in continued disintermediation out of long-term savings products like 10, 20, or 30-year treasuries and long-term corporates into instruments that historically have preserved people's purchasing power, like gold. Many new adherents to gold, Steve, express impatience about the move. When will gold move? I point out to them that I began to acquire physical gold again systematically beginning in 1998. And I measure my gold holdings from the year 2000, which is to say the beginning of this century on. Gold in the last 24 years has increased by my measure at 8.3 or 8.4% compounded for 24 years. In other words, when will gold move? Well, 24 years ago. That's what it's designed to do. People are looking for dramatic upside, the type of upside that they enjoyed if they were alive in 1970 to 1981, or in the period 2000 to either 2008 or 2011, depending how you define that epoch. I get that. But gold's job isn't to deliver dramatic upsides. Gold's job is to maintain your purchasing power over time. And it's done a truly spectacular job of that. I think, unfortunately, it'll do a better job going forward for the reasons that you described.
Okay. Piggybacking off that, and since this is priced in dollars, and essentially the more that the dollar is worth, I'll call it, the fewer of them it takes to buy gold or a barrel of oil, and the less it's worth, the more it takes of them. So right here is the DXY, the dollar. We've kind of just been in this range for a couple of years. Do you see this breaking down as the Fed starts to cut rates, which Vegas odds have them doing at last I checked about 95% for their next meeting in September? Would you anticipate the dollar to get weaker when that happens?
I would, but not materially weaker.
Okay.
As our mutual friend Doug Casey points out, the US dollar is the worst currency in the world with the sole exception of every other one. It isn't that the dollar independently is strong, but the DXY measured it against other currencies.
Yeah.
And that's a bad league. Winning the currency war is like being the best basketball player in a league of pygmies. So I think people need to look at that. I do believe that the US dollar will be less globally competitive when the nominal interest rate in the US dollar declines relative to interest rates payable in those other currencies. But I believe that the US dollar will continue to be the strongest currency, fiat currency in the world for a long period of time.
Okay, dollar milkshake theory. Alrighty, how about this one? This is the tens and the twos. Okay, so the 10-year yield minus the 2-year yield. You're smiling because you know exactly where I'm going with this. We've been in, I call it upside down clown world here for about 2 years, where for some reason short duration debt is paying more than long duration debt. Once we hit this white line and go above, typically if you have a rapid increase like here before where you could see the arrows, that's where we go into a recession. Do you see anything that might counter that, or what are you seeing with this chart?
Well, I think recessions often are good for the long-term bond. The fiscal response to a recession is always to lower the nominal interest rate. Lowering the nominal interest rate is good for the 10-year. I think the chart overall reflects the fact that people's investing decisions have been shaped by 40 years of falling interest rates. And I think those perceptions are wrong. I think the world changed in 2022. It's odd that now we're in a circumstance where Wall Street doesn't talk about bonds in terms of provision of capital. They talk about bonds as trading vehicles. This to me is insane. This is to me is like proverbially stepping in front of a steamroller to pick up quarters.
Mm-hmm.
But the market has been trained for 40 years to buy dips, to believe in continued absolute strength in the US dollar and lower interest rates. I think that the behavior that you see exhibited in the chart is a behavior that's going to change the same way that behaviors changed in 1968, 1970, and 1975. I'm delighted, frankly, that the short-term bond pays more than the long-term bond, because I have no interest in owning the long-term bond under any circumstances at all. And I own a fair amount of short-term treasuries. While I understand that the yield on short-term treasuries doesn't cover the deterioration in purchasing power that I suffer as a consequence of owning them, I believe, for reasons that you and I have described, Steve, that I need to have US dollar liquidity anyway. And I regard the foregone interest as an option premium, so that I have the liquidity to take advantage of a liquidity squeeze should one occur, rather than being taken advantage of by that liquidity squeeze.
Okay. Yeah, I like the short-term treasuries too. It's pretty amazing. You can get 5.3% for
Truly
only
insane.
tying it up for a month.
Relative to the 10-year, truly insane.
Yeah, yeah. Okay, silver.
Yep.
Right here, we were going wild with the faces the other day, I guess. Okay, we're sitting right around 29 right now. You basically said that you could be neutral to bullish on this one. Investment demand doesn't really, industrial demand doesn't necessarily drive this as much as investor demand when people get scared and then they pile into this thing. Is that right?
That's what I've observed historically. I don't know necessarily why it's true. I don't want to give you the why, and I like to know the why before I invest, which is why I'm neutral. Here's what I do know, Steve, based on history, nothing else, just based on observation. Precious metals bull markets, major ones, secular ones, or cyclical ones, are led by gold. When the narrative becomes adopted by the generalist investor, leadership changes from gold to silver, perhaps because that investor is more greed motivated than fear motivated, perhaps because of the lower unit value of silver, or because perhaps people who study bull markets historically simply note that silver has more upside volatility than gold. Again, I can't tell you why, I can just tell you that. I believe that the generalist investor will be attracted to the precious metals narrative. I believe that that'll happen. I believe it's happening now, but I believe it'll happen in earnest in the next 2 or 3 years, maybe sooner. Experience tells me that when that happens, that the generalist investor will be more attracted to the silver narrative than the gold narrative. And silver will begin to outpace gold. While the nominal all-time high in the silver price is about $50, so substantially above the current price, the nominal all-time high in the gold price has already been eclipsed. And while I don't put much of a valuation delta on those two parameters, I think it's easy to put a behavioral delta between the two parameters. And I don't, in other words, I don't think the delta is worth anything, but I think the delta is an easily explainable story that will seduce the generalist investor. A factoid, something that isn't necessarily true, but is relevant because it's easy to understand, even though it's not necessarily true.
Yeah. I'm curious what the inflation adjusted price of silver would be right now. I might be able to do that with these charts. I'm not sure.
Yeah, I was going to say, you need to get a smart intern. Those are really good investments.
Yeah, right. I like that. I'm going to bring up copper here was next on the list. And so we've had an amazing run up in copper, got north of $5 a pound. And then we settled back down around $4. Do you think this is Dr. Copper forecasting a possible coming recession? What do you read into this?
I think two things. I think that there was a copper narrative, and the copper narrative coincided with things like the political problem around Cobre Panama and job actions in Chile. It also probably coincided with an attempt by the Chinese government to stimulate the construction industry in China. And so I think that $5 was an aberration.
Okay.
In other words, I think it got ahead of itself. In my experience in financial markets, when you see what the Canadians would describe as a hockey stick graph, like the one that you see there,
yeah,
generally the backside is almost as steep as the front side. It's just a lot less fun for bulls. And I think what you're seeing here is likely reversion to mean. If you have a 5-year horizon, which I think you have to have in the copper business, what you understand is that we have for 30 years underinvested in copper. The average mine grade in the copper business has fallen from 1.5% to 0.5%. We got to move a lot more rock to get the same amount of copper. And no matter what we do, absent a global depression, we have supply shortages 5 years out. No ifs, ands, or buts. Unaddressable supply shortages. Coming into that, we have a world where not just the copper price will increase, but the cost of producing copper will increase, particularly the social rents, taxes, royalties, and permitting delays, so that increases in the copper price won't lead necessarily to concomitant increases in margins, particularly not margins around people who have to build copper mines, because the cost of building copper mines is escalating rapidly. But these very permitting activities, permitting delays, and the fact that we're going to have an inevitable decline in supply means that the very large tier 1 copper deposits that have 25 or 30-year reserve lives are worth much more than people believe them to be worth now. Steve, there's one copper deposit in the United States that illustrates this. The Resolution deposit in Arizona is a supergiant copper deposit by any stretch of the imagination. And its grade is comfortable in excess of 1%, approaching 1.5%. This mine has been in the permitting stage for 26 years. It is estimated that the capital costs of constructing this mine, ex social costs, are increasing at about 12% compounded. meaning that if next year, if it were permitted, it would take $8 billion to build. The year after that, effectively, it costs $9 billion a year. The year after that, it costs $10 billion a year. You get my point.
Yeah.
What this means is that mines like Escondida, mines like Grasberg, these very high quality, very long-lived mines that are already permitted, already built, already understood, are going to be much more valuable than people think they are.
Okay, that's good if you own copper. Do you see this as kind of like I drew this, I'm kind of a technical guy, but I drew like this upward channel trend line. Do you have like a floor in mind that you think for copper? 350, 380?
Nope.
No?
No, you'd have to be a better economist than I. I'm a credit analyst.
Okay.
The only thing that stands between us and sharply higher copper prices, I think, over 5 years, is the specter of a worldwide recession or depression. What you learn if you've been in the mining business long enough is that even big industries like copper, if there's a temporary oversupply, can go cash neutral or cash negative over time. If you have spent $5 billion building a copper mine, you will produce and sell copper at $4 a pound, enjoying maybe a $2 gross operating margin. If the price goes to $3, you'll produce it, enjoying a $1 a pound operating margin. If the price goes to $2, you'll produce it, generating no operating margin because you know it'll cost you a bunch of money to shut it down. And you are trying to produce cash even if you aren't covering your depletion and depreciation charges. If the price goes to $1.50 a pound, you may produce it losing 50 cents a pound, trying to win the last man standing contest so that you're still alive when your competitors have to shutter their mines and the rebound comes. If you're a copper investor, you need to understand the possibility that copper, in the context of the future economy, rather than having stair steps to heaven, has an escalator to hell. That you go through a period like the late 1980s and early 1990s, where for 5 years the copper industry as a whole is generating negative EBIT.
Okay. I was going to pull up the 80s and 90s here. Oh, looks like it only goes back to 89. Okay. And moving on to uranium. So we've been at this, our viewers here are very passionate about uranium. I drew in this white line as if it means something. It's at $80 a pound. I remember we were talking back here when it was boring and nobody wanted to hear about it, back when it was $45 a pound, $40 a pound.
Yep.
And you said absolutely positively has to go to 80 to make all the, to balance the books. And that's exactly what happened. Overshot like these usually do. And now we've kind of rested back down around 80. What do you see here? Does this floor mean anything to you, or am I just drawing a white line?
Means nothing to me.
Okay.
Understand that the lines you have drawn there are the spot price, and the spot price is increasingly irrelevant. On a daily basis, there's often more dollar volume in the Sprott Physical Uranium Trust than there is in the spot market.
Yeah.
Which means, in a sense, that the real spot market is the Sprott market. What's important to uranium share investors is not so much the spot market, but the term market. The term market is very, very opaque. Companies, for competitive reasons and other reasons, don't want to disclose their contractual terms. And you have some companies that don't want to enter into term contracts because they like the narrative of unbridled upside more than they like the reality of tempered downside. I'm obviously on the backside of that trade. What changes for uranium equities over the next 5 years is the increasing prominence of the term market, which gives uranium producers and consumers, by the way, certainty as to price and volume for periods of time as long as 20 years. No other commodity gives managers, owners, or lenders, or for that matter, consumers, stability of price and supply and visibility as to price and supply. What this means is that as the term market becomes less opaque, as details become more apparent, the cost of capital to the uranium industry ought to be the lowest cost of capital of any natural resource on the planet. And what that means is that fairly small companies that own economic deposits won't have to sell them. They'll be able to finance them to production themselves because they won't be financing based on their balance sheet. They'll be financing based on the balance sheet of the uranium buyer. Tokyo Electric Power, China General Nuclear, Duke Power, Southern Company. It doesn't mean that the junior companies will have to build the deposits themselves. It means that people who buy them out will have, as a floor price competitor, a self-constructed project. And that changes the whole game for the 10 or 12 legitimate uranium juniors.
Okay. Do you get excited when I see this discount here on Sprott north of 12? I start to get excited. I did it intraday, some napkin math, and found it at 18 one day.
Yeah.
Does this excite you at all, or are you re-entering the uranium game, or are you still just holding what you got?
I'm not a trader, Steve, but I must say, when there was a 15% discount, I clicked the buy button. It doesn't matter to me. I own a lot of Sprott physical uranium, and adding a little at a 15% discount is something I do as an amusement. It's not unlike having a nice glass of bourbon at night.
Yeah.
Buying the Sprott Physical Uranium Trust when uranium was at 40, and I knew the stuff had to go to 70 or 80, that was a no-brainer. I need to tell you too, and your listeners, so they understand the conflict. I'm the largest shareholder of the manager of Sprott Physical Uranium Trust. And Sprott Physical Uranium Trust, as I remember it, pays a 40 basis point fee to Sprott. So I'm an enormous beneficiary of the physical trust, even before I own any.
Yeah. Your collected rent, whether it goes up or not.
Yeah, that dividend from Sprott, with, I don't know, $5.5 billion, whatever it is, in AUM. Think about 40 basis points on $5 billion. And think about the expense associated with that revenue at the Sprott level. Once every 4 months, you send KPMG in and they go one can, 2 can, 3 can, 4 can. In that business, which is to say managing the trust, their gross is their net.
Yeah. Yeah. Okay. And let's move on to oil. So oil's had a kind of an interesting pullback here recently. We're sitting at, what are we at? $73 a barrel right now.
Yep.
Said you're bullish on oil. How do you see oil going here?
I should change that by way of saying I'm bullish on oil stocks.
Okay.
Oil companies are making a shitload of money.
Okay.
At $73. I mean, they're making boatloads of money at $73. Most oil companies, including almost all of the parastatals, aren't reinvesting in their oil business. They're subsidizing politically expedient domestic spending programs, in Nigeria, Venezuela, and Mexico, as an example. They're returning money to shareholders by way of buybacks or dividends. And the fact that they're underinvesting in their basic business by about $1 billion a day means that there will be production shortfalls 2 or 3 years from now. For those companies that are maintaining their sustaining capital investment and maintaining new project investment, while at the same time generating so much cash that they're returning capital to shareholders, both by way of increasing dividends and increasing buybacks, this is just the best of all worlds. The market, including the institutional investor, is in many ways anti-oil, often because there are fund managers who care more about political expedience than they do at making money for their investors. but also because the big thinkers of the world will tell you that the end of oil is in 2030, which is ridiculous. So these oil companies are priced as though there's no free cash flow after 2032. And I believe that their free cash flow at 2032 will be substantially larger than it is today. So I assign a tail value to the oil market that the institutional investors don't.
Okay. We'll still be driving cars past then, so the bet
You
is
think?
on.
You think, Steve, the big thinkers need to ask themselves, how will they fly 1,000 private jets to Davos to tell you to drive less if there isn't jet fuel?
Very true. Okay, natural gas. So
Yeah.
we've been talking
Better
about
yet.
this one for, I
Yeah.
don't know, a couple years. I started getting excited back here.
Yep.
And, we're just sitting at $2. And, you said neutral here in the short term, but wildly bullish in 5 years. Some catalysts I can think of is if Trudeau gets out, then our Canadian friends should actually be able to export this stuff that they have so much of. What are you seeing with natural gas?
Well, the first catalyst is the one that you described. Even at $2 gas, if the Canadians could sell it, you would see, the tourmalines and the birch cliffs and the peytos double the month after Monsieur Trudeau was thanked and excused. I'm not saying that's going to happen, by the way. I'm not a political analyst. But the more important trend with natural gas is BTU price parity. Natural gas is selling at about a third of the BTU price of oil. The landed price of liquefied natural gas in Rotterdam or Shanghai is about $8 per million BTU. That same gas in the United States or Canada sells for $2 a million BTU, and it takes in round numbers $1.50 to get it from here to Shanghai or Rotterdam. That delta between $3.50 and $8 is too big to continue. Every month, $1 billion or so is spent on arbitraging that delta. Natural gas consumers in Europe, particularly in Germany, people who are like fertilizer producers or petrochemical producers or other companies that use natural gas, are shutting down in Europe and relocating to the US Gulf Coast to access our gas. At the same time, transmission and storage facilities and liquefaction facilities are being built, and billions of dollars are being spent. Meanwhile, in Tokyo and Shanghai and Taipei and Rotterdam, billions of dollars of receiving facilities are being built. You've heard me say many times, Steve, the cure for low prices is low prices. And the longer this chart continues, the longer that there is a substantial disparity between the BTU equivalent price of gas and the BTU equivalent price of oil, and the longer the delta exists between the landed price in Europe and Asia and the produced price in North America, the more certain the upside is in natural gas. Despite these very low prices, there are gas producers, particularly those who produce it as a co-product from natural gas liquids or oil, who are making substantial amounts of money at $2 natural gas. Look at Devon in this country. Look at Equitable in this country. Look at Coterra in this country. Or better yet, look at Tourmaline, ARC, Peyto, Birchcliff, Freehold in Canada. These guys are doing great at $2. With the exception of Peyto, Birchcliff, they are reinvesting enough in their basic business to maintain production while at the same time paying generous dividends and buying back stock, increasing your proportional interest in their reserves. Is this something that's going to change in the near term? No. Does the near term matter? Except in investor psychology? No.
In the accumulation stage.
Yep.
Okay. And quickly, let's run through nickel. I labeled this one as right up there with lithium as far as hated. And so we can just see on the chart
Yep.
that's in the toilet,
Yep.
started getting excited as it's just falling. And here we are. Same kind of thing with lithium. I mean, this is an even more
Yeah.
exaggerated chart here. What do you see with these battery plays?
Yeah, you could add platinum and palladium to that too.
Yeah.
It's the same juxtaposition of um, narrative to reality and supply. We'll start with nickel. The first thing that went wrong is that nickel got too overhyped, so it went too high.
Mm-hmm.
The second thing that happened is that the Chinese invested billions of dollars in laterite nickel production in Indonesia, with, by the way, paying less attention to the environmental costs associated with that production than any of us should have. My belief is that the growth in lateritic nickel production, the peak in lateritic nickel production at these prices probably occurs 12 months from now, which is to say that we are close to the beginning of the end of supply increases. My belief is, because I've flown over those deposits, those mines, that the incredible environmental degradation that's being caused will not be tolerated by the citizenry of Indonesia for too much longer, which means that the production costs will increase greatly. This production is also extremely energy intensive. And if we were, for any reason, although I'm not forecasting it, to experience a spike in energy costs, the cost of producing byproduct nickel increases. But what's important about this chart is that people, fabricators, nickel users, were deferring investments in fabrication technology around nickel because of price spikes. They were looking for ways to substitute other materials for nickel, and they were looking for ways to conserve nickel in their fabrication technologies. They aren't doing that anymore. Remember that the cure for low prices is always low prices. The cure for high prices is always high prices. Markets work. So for me, the bloom is really truly off the nickel rose, but that hasn't changed the utility of nickel in fabrication. So for me, sulfide nickel deposits that are pre-development, provided that they're world scale, represent great speculative opportunities because nobody's competing with me. I can buy deposits that I think will be tier one deposits. My definition of tier one is $10 billion in situ recoverable reserves with lowest cash cost quartile profile, lowest quartile in the industry, and high returns on capital employed, but at least 25% at normalized nickel prices. I can buy those companies now with absolutely no competition. The idea that you can buy a tier one deposit with a $300 million market cap or a $400 million market cap, where you reasonably believe that 5 years from now you could have a 10-bagger, is a really interesting circumstance. You have to be willing to endure 2 years of torture. I'm 71 years of age. I've endured 2 years of torture in numerous names over the last 50 years. So that doesn't bother me at all. I think the opportunity is greater in lithium because the overinvestment in lithium was much more dramatic
Yeah.
than it was in nickel. What that means is that the number of deposits that you'll have the ability to choose from 2 years from now is much greater. And the number of speculators in the lithium market probably exceeded the number of speculators in the nickel market by a factor of 20. If you're like me, a connoisseur of hate, the idea that you have 250, 300, 400,000 retail speculators who hate something is the best possible circumstance for me. I suspect that 2 years from now, the nickel market will have bottomed, that the availability of capital for nickel companies will be zero, and that people will regard lithium as a four-letter word, that they will be selling with the same intensity, the same disgust, the same hate that they were the uranium stocks in 2021. Just in time for the low prices to clean out supply and increase demand. Wonderful circumstance. Actionable in 2024? Absolutely not. But it's a business that you have to learn a lot about in anticipation for what will be a response that is at least as dramatic as the uranium response was.
Okay. Maybe 2026, 2027, that ballpark, somewhere in there?
Yep.
Okay.
Yep.
Okay. All right. And wrapping up here, coal. So we got thermal coal here. Today it's at 146. We got met coal here at 203 today.
Yep.
What do you see looking forward with coal?
Most people look at the met coal with more favor than the thermal coal.
Mm-hmm.
Well, that means that met coal isn't as hated. Both materials are generating really substantial free cash flow relative to market cap. And in both commodities, the companies that produce them are annuities. Many people don't realize this, but the largest year in recorded history for coal demand was 2023. And so far in 2024, we're exceeding 2023 demand. Many people who are anti-coal for climactic or other reasons fail to take note of the fact that there's 1 billion people on Earth with no access to primary electricity. And those people want to live like you and I do, Steve.
Yeah.
Whether we like it or not, the cheapest form of baseload power is thermal coal. The Chinese, while they're building nuclear power plants and building solar facilities and building wind farms, are building thermal coal generating capacity like mad. But they're actually behind the Indians now. And that doesn't take into account power plants being built in Namibia and Botswana and South Africa and Malawi and Sri Lanka. Whether we like it or not, these prices continue or perhaps increase. And the market reaction to this, well, the coal stocks have done extraordinarily well in the last 3 years.
Yeah.
They've done it off a base that could be best described as free.
Yeah.
In 2021, I think it was, Glencore was able to buy a 40% interest in a Colombian coal asset where they owned the other 60.
Yeah.
They were able to buy that to 40% interest at 18 months free cash flow for a deposit that had a 35-year reserve life. I've never seen an opportunity on a global scale like that, with the sole exception probably of Exxon when it got kicked out of the Dow 30.
Yeah. Okay. All righty. Well, thank you very much, Rick. That was incredible. Love to get your macro view on all those. This Saturday, August 24th, we have your private placements bootcamp coming up. I'm really excited about this one. This is for serious investors. Give us an overview and what we can expect this Saturday at the private placements bootcamp.
This is not an entertainment product, and it's not for tourist speculators. This is for people who are accredited investors, defined in the United States as having $1 million portfolios plus. And this is really a deep dive into the technique of private placements. We'll cover private company and pre-public private placements. We'll cover aftermarket private placements, that is private placements in existing public companies. We'll cover debt private placements exclusively. More people ought to pay more attention to debt than they do equity. Take away some of your upside, but take away damn near all of your downside. We'll talk too about private placements in funds and partnerships, how to do it, how to access them, how to do due diligence, how to construct a selling strategy. This will be 8 hours of very intensive programming. $99 charge, fully refundable if you don't think you got your money's worth. Importantly, you will have access to the recordings, and you will need them. because we're going to give you more information in 8 hours than you can absorb in 8 hours. It's taken me 45 years to learn the information we're going to impart. It's going to take you more than 8 hours to get it. Once again, no insult. If you're a tourist in the space, if you are inclined to the space for entertainment, this isn't the right sort of global macro discussion for you. If you are serious, if you want to do the work, if things like the Rule Classroom, learning how to do securities analysis, learning how to do rudimentary geology, learning how to read balance sheets and income statements and do risk-adjusted net present value analysis, if this is of use to you, in other words, if you're serious, if you actually want to make money, this is probably invaluable. And I take all the financial risk.
I look forward to it. If it's like any of your other boot camps, it is always beneficial for our bank and brokerage accounts. So Rick, I look forward to it this Saturday, and yeah, I'm ready to work, ready to learn.
Great. I look forward to having you on the Real Classroom this afternoon too, for those who care. And then finally, if I may, anybody who wishes can access my views on natural resources in a personal fashion by going to ruleinvestmentmedia.com, listing their natural resource stocks, and I personally will rank them 1 to 10. I'll comment on individual issues where I think my comments might have value. Further, I invite you to visit the Rule Classroom, where there are over 200 hours of instructional programming, all for free, the best possible price. Finally, if for any reason at all you're upset about your current bank, as an example, if they don't pay you interest on your checking account, check out Battle Bank. Or at Rule Investment Media, under the question and comment section, simply write bank. We're constructing a bank that is designed to battle for your business, including simple things like making sure that you own your own IRA and that we pay you interest, fair interest, on the money that you deposit with us. That's battlebank.com or at Rule Investment Media.
Awesome. What's the minimum deposit for Battle Bank?
Well, it's not open yet. Our forecasted minimum is $5,000.
Okay, so pretty much anyone can join.
Yep.
Awesome. Well, thank you very much, Rick. This was a lot of fun, and you have a great rest of the day.
Thank you, Steve. I look forward to being on air with you shortly.
Yes, yes, and thank you for tuning in. Join us over at the Rule Classroom and the Private Placement Boot Camps. All the links are down below and in the pinned comment below. Thank you for tuning in and support the show. Share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.